Imagine a product that generates massive profits without producing anything tangible, a product so invisible that most people don't even realize they are buying it every single day of their lives. That product is debt. Debt is not, as often believed, merely a neutral financial tool. On the contrary, it was deliberately designed to be the most profitable product in human history. It has funded wars, toppled empires, enslaved nations, and quietly, imperceptibly, siphoned off the existence of ordinary people. Yet, ask anyone on the street where debt comes from, who designed it, or why it dominates our financial system so completely, and they won't be able to give you an answer. That is because the story of debt is not just dry economic history. It is the story of money and power itself. At its simplest, debt is a promise. You take today and you agree to pay tomorrow. But hidden within this innocent promise lies the core of financial control: interest. To demand interest is to turn the future into profit. For thousands of years, societies wrestled with this idea. The ancient Mesopotamians carved debts into clay tablets, but their leaders, knowing the system would collapse if too many citizens were crushed under the burden, would periodically declare debt amnesty and wipe the tablets clean. Even the Hebrew Bible commands that debts be forgiven every 50 years. The idea was simple. Debt was dangerous. Left unchecked, it could enslave an entire population. However, fast forward the timeline a bit, and you will see how the elites learned not to forgive debt, but to weaponize it. In medieval Europe, the Catholic Church banned usury, charging excessive interest. But merchants and bankers found ways to cook the books. They disguised loans as trade contracts or invented complex instruments that, from the outside, looked nothing like loans. By the Renaissance, giants like the Medici family in Florence built their empires not on land or armies, but on lending. They financed kings and popes. In return, they bought not just money, but political power. Debt was no longer just a financial product. It was the engine of power. The real transformation occurred in the 17th century when states began to borrow. As the Dutch Republic fought a war of independence against Spain, it raised money by selling bonds to its own citizens. People bought government debt, earned interest, and could trade these bonds like property. Suddenly, wars were no longer limited by the gold in a king's treasury. By selling the future, it became possible to finance wars indefinitely. The Dutch perfected this model, and the British immediately copied it. With the establishment of the Bank of England in 1694, national debt became a permanent institution. The state no longer borrowed from individual figures. It borrowed from a central bank that printed banknotes against this debt. For the first time in history, a government didn't just borrow in emergencies. It lived on debt, rolling over debt, with more debt. The bankers managing this became indispensable to the crown. Debt moved from private contracts to the very foundation of state power. The profits were enormous. Lending to the state was the safest gamble in the world, because governments could raise taxes on the public to repay their debts. Wars that used to bankrupt kings could now be sustained indefinitely. These wars expanded empires, opened new markets, and created opportunities for even more borrowing. It was a perfect cycle. As nations fought, they borrowed. As they borrowed, their creditors grew richer. In the 18th and 19th centuries, the stock exchanges of London, Paris, and Amsterdam were the beating hearts of global finance. Armies marched, ships set sail, colonies were invaded, all on borrowed money. But this story isn't just about states. As industrial capitalism spread, ordinary people were pulled into this gear. Railways and factories were all built on credit. Workers received wages from companies running on debt, then went out and incurred debt themselves to buy homes, tools, and eventually consumer goods. Debt seeped into every cell of economic life. By the time we reached the 20th century, debt was no longer just a toy for governments or tycoons. It had become an everyday product sold to the masses. Mortgages, car loans, credit cards, student loans. The entire architecture of modern life was built on normalizing being in debt as the default mode of existence. The hidden genius, or hidden cruelty, of the operation is this. Debt doesn't create profit just once. Every interest payment is a wealth transfer from the debtor to the creditor, from the masses to a select few, repeated every month, every year. Unlike a product you buy and use once, debt is designed to be permanent, to trap you in a never-ending cycle of payment. A house bought with a 30-year loan costs 2 or 3 times its sticker price. A credit card debt where only the minimum is paid grows faster than your ability to pay. What started as a promise turns into a trap. In short, debt is not just a financial arrangement, it is the most successful business model in history. It requires no factory, no inventory, no raw materials. It generates money from time itself. And those who figured this out earliest, the merchants of Amsterdam, the bankers of London, the financiers of Wall Street, became the architects of the modern system. This system does not manage debt. It manufactures it, inflates it, and depends on it for survival. In the mid-20th century, debt ceased to be a tool used in crises and became the lifeblood of the global system. Institutions like the IMF and the World Bank, established by the Bretton Woods Agreements in 1944, operated a simple mechanism behind fancy words like development and cooperation. Debt as a tool of discipline. Countries could borrow, but the creditors set the terms. The IMF began dictating to countries what to cut and what to privatize under the guise of structural adjustment. Debt was not just profitable, it was a mechanism of political control. Heavily indebted nations lost their sovereignty. Their policies were written in Washington, not in their own capitals. The rhetoric was stability, the reality was dependency. During the same period, a quieter revolution was taking place in the lives of ordinary citizens. After World War II, banks found a way to sell debt to households. Home ownership was the great dream of the middle class, and this dream was offered to millions, on the single condition that they sign the signature that chained the family to payments for 30 years. Car loans, installment plans, and finally the credit card turned debt into a consumer object marketed just like any product on a shelf. The psychological shift was massive. Debt was no longer something to be ashamed of. It was the normal way to participate in prosperity. Buy now, pay later. Enjoy today, worry about the future later. For banks, this was a gold mine. For governments, it was the illusion of infinite growth, created by people spending on credit, even if wages didn't rise. Debt became the hidden engine of modern capitalism. And unlike selling physical goods, selling credit was infinitely scalable. You didn't need to dig mines. You only needed signatures and the authority to create money from promises. The danger was this. The entire system became addicted to this expansion. Banks didn't want immediate repayment. They wanted the debt to be rolled over, restructured, extended. The longer people remained in debt, the more profitable it was. Governments also discovered that borrowing was easier than raising taxes. Politicians locked the bill for today onto future generations. Central banks kept the wheels turning by printing money. Debt was no longer a temporary bridge, it was the permanent foundation of the system. In the 1970s and 80s, the price of this addiction was heavy. Developing countries, encouraged by Western banks, sank up to their necks in debt. When interest rates suddenly spiked, countries like Mexico said, "We can't pay," in 1982. The solution? More debt, with harsher terms. Debt became a trap. Borrow to survive, borrow again to pay back, and with every cycle, lose a little more control over your economy. In the West, the financial sector found new ways to package and sell debt. Loans were bundled together, sliced up, and turned into securities traded on the global market. Debt ceased to be a contract between a borrower and a lender, and transformed into a tradable commodity. Wall Street was no longer interested in production, but in debt engineering. This process, known as financialization, made credit the raw material of the modern age. The profits were jaw-dropping. It was said that risk was distributed, but in reality, risk was merely hidden. The 2008 crisis was the explosion of this. Those complex debt packages, said to be unsinkable, blew up. Debt had exceeded the boundaries of reality, and when it snapped, the whole world trembled. So what happened? Instead of punishing those who sold this toxic debt, governments bailed them out. While ordinary families lost their homes, banks received rescue packages. And when the dust settled, debt usage didn't decrease. It increased. The crisis itself became an excuse to create even more debt. Today, debt is not just profitable, it is indispensable. Every part of the global economy depends on it. Without debt, the system collapses. Debt is the ultimate product that holds everything else up, can be sold endlessly, and can be inflated forever. The unbacked money printed post-2008 only fueled the addiction. Today, global debt exceeds $300 trillion, more than 3 times the world's annual production. Never in history has humanity owed so much to such a small minority. The irony is that this mountain of debt is celebrated as growth, yet what looks like prosperity is merely leverage upon leverage. Inflation is the hidden tax of this system. It melts the value of money to grease the gears of the debt machine. And the profitability of debt has never been higher. Banks earn not just from interest, but from restructuring, collection, and risk trading. Debt operates as a mechanism that concentrates wealth. Every interest payment moves money from the bottom up, from millions of households into the vaults of giant banks. Debt is class division, polished by the financial system. Now, a new evolution of debt is on the horizon. Central bank digital currencies, CBDC. Programmable, traceable, and controllable money. Loans approved by algorithms, instant penalties. It may sound like efficiency, but if the history of debt has taught us anything, it is this. Efficiency for the creditor means less freedom for the debtor. The most profitable product in history is being updated for the digital age. So, what is the lesson to be learned here? Debt is not neutral. Debt is not a natural part of modern life or a simple tool for progress. Debt is the most profitable product, deliberately designed to turn time into money and people's hopes into rivers of interest flowing upward. True financial freedom cannot be something the system offers you, because the system is built on you remaining in debt. True wealth is minimizing dependency on debt, questioning those promises of easy credit, and seeing that behind every loan offer lies a machine designed to profit from your future. History doesn't repeat itself exactly, but it rhymes. From the clay tablets of Mesopotamia to the mortgaged homes of the suburbs, the story is always the same. Debt enriches the creditor, crushes the debtor, and shapes the world in favor of those who hold the money tap. And the greatest trick is that they taught us to celebrate this. They taught us to mistake indebtedness for prosperity.